Welcome to another ACY Securities Lockdown Edition podcast. My name is Alistair Schultz and I'll be your host through today's trading journey. In today's podcast, I've been joined by James McGill from Chatham Capital. James has an extensive history in financial services and has been an active governance and advisory board member for a variety of different institutions. In today's podcast, James and I are going to be discussing what it's like to be a board member and some of the key differences between listed and unlisted investments. Well, that's all we've got to start off with. Hello, James. Welcome to the podcast. Thank you very much for joining us today. Would you be able to tell us a bit of an idea of who you are, what you do from your own perspective?
Alistair, thanks for having me along. Sure, my background's relatively varied. Includes a lengthy period in stockbroking, funds management, and then also working in energy industry and a few other places through times of, say, deregulation and competition. I'm currently a partner in a firm called Chatham Capital, and we work primarily with companies to help their growth aspirations, so longer term growth aspirations, and from time to time with those companies and with other companies we help them with capital raisings or mergers and acquisitions. Off to the side, I'm the treasurer for an angel investor group called Southern Angels. It's one of the, well, probably is the largest group in South Australia. So we work a lot with startup and emerging companies as they're going on that first or second capital raise journey.
So have you found that being in this sort of an industry, it's been primarily you work a lot with startups, or are you going for more the seed investor sort of roles and building upon them and helping them grow as much as they can?
Certainly with Chatham Capital, we work with what we call emerging companies through to established firms. So our definition of emerging are companies that have a product in the market. They are post-revenue, so they have customers, they've got revenue. They'll be recognised as a legitimate company. And the reason we work with them is because they've gone through that pain period where a founder has taken an idea through their initial validations, and so many companies at those early days will not survive. And so to build effectively an advisory business model around companies that have a very low chance of success isn't very sound. So Chatham will focus on companies in their later stages. But the reason I got involved with Southern Angels is because I love that early stage marketplace. There's a lot of interesting ideas, there's some fascinating people, and I can do that, and as I do, it's on a volunteer basis essentially. So I give my time to that group. And I do that because if we don't have a strong, vibrant startup community, that's where the future companies are built. If we don't have that, then it really does put a little bit of a handbrake on an economy. And I love being involved in that area, but that's done on a volunteer basis.
Yeah, so it's almost like on one side you've got the aspect where you're looking at the feasibility, the desirability, and how well that company is going to go at the very early onset and helping them grow, whilst also having that experience on the capital raising when they've gone through all that initial phasing of being a startup and are really starting to grow. How did you get into the industry?
I was lucky. Back in the early 1990s when I started, I was able to get a summer job in a stockbroking firm, and that literally was carrying boxes, doing the daily runs to the bank. This is pre-electronic time, so the trading floor was just starting to close down. Lots of manual activity. So I got a summer job helping a broking firm with that. I was at university at the time, and stockbroking was the first thing that really grabbed my attention and interest as an exciting place to work. And for those who have followed, I guess, broking, and you see the movies, whether it's Wolf of Wall Street or Wall Street, 99% of what happens in broking isn't like that, but it's still pretty exciting. So that grabbed my attention. I started studying what was the original stockbroking financial courses, and I was able to then turn that into a part-time job that became a full-time job after university.
So was that really the introduction to you starting to invest?
No. Well, investing my own money, yes. Living at home, being a student before then, there was really nothing to invest. But like so many schools, the school I went to ran, I think it was in the economics program, ran an investing module in one of the courses we did, These used to run, often the local newspapers would run a learn to trade kind of game, effectively. And we started doing that.
I can remember seeing them even my own generation bracket.
Yeah.
That was a common place for economics in school.
Yeah, great fun, right? And I think I remember some of the companies that I used to look at then, and I think that was the first opening of an idea of what stockbrokers actually did. Having said that, I think in my last year of school when the 87 market crashed, and it's interesting that, if I'd been in stockbroking then, that would have been a horrendous day. But if you're not in broking at that point, it was, you're fairly isolated from it. So I think even though I had an interest probably in around that era, if you don't lose money, what happens in the markets often doesn't really grab your attention. It's funny how money in the game grabs your attention, and I think that's an interesting piece for people who are getting started in stock markets or investing. How you change your views when you've got your own dollars invested in something. It goes from being interesting to it really grabs your attention.
So what was your very first investment? What did you invest in, and how did it go? I mean, obviously getting into it with, not long after the sort of 87 crashes and those sort of things. What did you end up picking?
Look, a long time since my first investment, I don't recall what they were, but being in broking, the advantage in broking, and this is something that I've become more aware of since being out of broking, the advantage in broking is that you're around the trading environment the whole time. You're surrounded by people who are trading for clients and for themselves a lot. And my early trades were predominantly the small cap shares, because they were cheap. Talking here of the companies that were trading at 2 cents, 5 cents, 10 cents, because they were cheap. You could buy relatively small parcels of them, and they had some volatility. So you had the opportunity during the course of the day, overnight, in a short term, to be able to trade. And I'm fairly sure that I made probably very little money out of those first few months or couple of years of trading, but it certainly was a great experience. I think you get to understand what your own profile is, your own risk appetite, and are you, naturally someone who's a risk taker, and therefore you're suited to more volatile shares or volatile industries, or are you someone who's a little bit more conservative, who wants to go to work the next day, look at the pricing, and understand that even if the markets overseas have been in the red overnight, there's a fairly good chance that your company's still going to survive. And there were certainly some times early on where there were companies that I was trading where there's a very good chance, if the markets were tough overseas or there's something happened in a certain sector, that these companies were, there really wasn't much to them. I think you learn how to pick those companies. And my natural profile, I learnt, was less risk averse, certainly more geared towards companies that had good fundamentals, and that was what I learnt, how to trade in the longer term, and eventually stayed away from the very volatile shares, apart from money that I was prepared to wave goodbye to.
So considering you've learnt what your risk profile is obviously early on, and have obviously adopted some level of strategy, I suppose, to how you do go about your own investing, what are you currently investing in sort of today?
I'm very much weighted towards blue chips, in the current portfolio is underwritten by some level of dividend, and companies that have, I guess, fundamentally good business models for probably around 80% of our portfolio. The other 20%, some exposure to the overseas markets, but I do that through funds. I don't hold direct shares in the overseas markets, and the reason for that is I just don't have time to take the direct interest in what's happening in the overseas markets. And whilst there certainly are brokers in Australia and financial planners who have an interest in overseas, for me it's just not worth the time and the effort and the risk with currencies, etc., to have a direct view. I want that sort of risk spread. But the other 10% is what I now have as my fund exposure, and that's shares. I don't want to lose money there, but if I wipe the whole lot out, then it's not going to be the end of me. But I'm currently more focused there in the biotech sector, and the reason for that is I think there's a lot of interesting things happening in biotech, and the more you dig into it, I think you get an understanding in a certain sector. So again, I've got a spread of shares in there, so you need to have that diversity. But we're also seeing a lot of companies in that space, in the startup and emerging scene as well. So the more time you spend talking to people in a particular sector, the more comfortable you get with it. And I've also got a broker who's very, very strong in that sector, which makes it a lot easier. But for 80% of what I do, it's blue chip, and I think most recent share purchases we made in about 23rd of March this year were things that I thought were relatively secure long term. So Qantas that had been hammered at the time, and I thought there was no way that Qantas was going to end up out of business.
Well, it's one of those companies that you just sort of know the government's going to pick back up again anyway.
Correct. It's like a bank, right?
So it's like the no-brainer decision really when it comes to those sort of stocks.
Spot on.
What's your current view on those sort of market dynamics that we're seeing now? I mean, we're not quite post-pandemic, but we're kind of in this limbo bit in the middle. Has that affected how you've been thinking about sort of long-term, short-term, near-term sort of things?
Look, it has. I am staggered really by how resilient this market has been, and the fundamentals don't, from my perspective, through my lens, the fundamentals don't seem to add up with where the Australian market is at the moment. I mean, certainly the volatility we saw through March and April has died away. The markets for that 6 to 8 week period were just amazing, and for those who are short-term traders, some amazing opportunities, but also some pretty bad hits taken, no doubt, through there. So my strategy when this started to take shape was we invested what we're expecting to be. We had some cash sitting in the portfolio. We invested some in that sort of later March period, and I was expecting to be putting the rest in late May. So that old adage of sort of sell in May, stay away approach, because June often is an interesting month as people square their books up. Portfolio investors, institutions square their books up in June for tax reasons. So I was expecting May to be a month where there would be a further opportunity, and I just don't know if that's going to happen yet, but I believe it should.
We're seeing also from sort of earnings season that's just gone past, a lot of sort of pretty dodgy or bad data occurring, and most of them have decided not to give forecasts for the next lot, and the real only thing that we can really see is that this second quarter is probably going to be worse than the first. Purely because of the lockdowns have really encompassed the full dynamic of what's really going on in that second quarter, whereas the first, it kind of slowly integrated into it. So perhaps that's made a little bit of a difference. If you could go back in time and visit your past self, what would be something, when you were first starting trading, what would be something that you would advise yourself right then and there? Knowing what you know today and being able to go back, what would it be that you would tell yourself?
So with my risk appetite in mind, less aggressive, more of a conservative person. And I've thought through this a number of times over a number of years. And the thing that sticks with me for those people who I've been most impressed by, and this is going back to client advising days, those people I've been most impressed by with the success of their investments that they've had and how they've gone about it. And it is probably the least interesting approach to investing, and that has been the older families, husbands, wives, whatever it might be, who used to come in and they would have 30 or 40 years of investing in what were really conservative stocks, blue chip stocks. These are the BHPs of the world, so they don't start off as blue chip obviously, but over time they become quality stocks. They'll buy shares, they'd often use the dividend reinvestment plans, and they would simply hold those shares unless there was a really good reason to sell. And I was staggered by the number of people who were from what you call normal jobs. They weren't earning millions of dollars, they were normal jobs, living normal lives, but they bought shares and they held and they reinvested and they kept going. They didn't sell. They avoided that temptation to sell, and they avoided the temptation to try and play the markets. And again, I'm full of quotes. Another one I believe, and which sort of sums up what I'm saying, it's more about time in the market than about timing the market. So that ability just to hold for 20, 30, 40 years, if someone can do that and they can make sure they avoid too few stocks and having a disaster in a small portfolio. I can be fairly confident in saying over long term, they've got a good chance of ending up with an amazing portfolio, and part of that is just the compounding effect as well, especially on dividend reinvestments.
Yeah. And that's a very like Warren Buffett way of investing as well. His old adage from some of his books and stuff is buy to keep it forever, not to ever sort of let it go. So I agree with it. I like that. I think that's something that's quite cool.
It's boring, right?
Now,
it's boring until you end up with
very
a
boring.
lot
It's
of
very
money in
boring,
30 years'
but,
time, and then it's fantastic. And I think that's the keys. If you have the personality profile and you can be boring, long term, it's like sticking money in a bank. If you stick money in a bank, even with low interest rates for 30 or 40 years, you can do okay out of that. So I think it's understanding what you're investing for. Is it for 5 years or for 50 years?
I've always liked to have a little bit of excitement in it. So, when it comes to my own investing, I've always sort of stuck a very small component of, my total capital towards, play money, basically is what I call it, to try and pick the winners and get them to take off if I can, or get into those risky sort of stuff. But the rest of the time, it's entirely buying to hold for a very long time to come and to continually reinvest in it. And even if I do get a winner that goes up in value quite quickly, and I cash it out, I take that money and I go and buy the boring stuff. So it kind of ends up being that it all goes to the same place. I might as well really just cut out the middleman operation for wanting it to be exciting. Now, I've got sort of 3 questions here that are almost identical, and it's going to go in order. So the first one is really, if you only had $10,000 today, what would you be investing it in now?
Personally, with 10K, I'm looking for probably a biotech type stock or emerging technology stock. I should have bought Afterpay about 6 weeks ago when they were down to $10. But
I got in at 9.
You'll be very happy. I didn't have the guts, so I didn't know if their business model was going to stack up. That beautiful hindsight. Look, certainly 10K. There's an opportunity there to do something that's you're not going to lose the house if you lose it. But that is a high risk proposition, so that's worth putting a bet into something. So for me, it's probably if I named a stock, I like a stock like Paradigm. That's a sort of a biotech type stock. They've got some interesting things and a business model that looks okay.
And then the same sort of question, but this time you've got $100,000.
100K becomes more interesting, doesn't it? You don't want to lose 100K. You don't want to go home and say to someone, "I've lost $100,000." So I'm definitely going into blue chip stocks. I'll ignore the portfolio allocations that make you have some money overseas, some in cash, etc. I am looking at those stocks that have been hit by the current environment, that are likely too big to fail. That maybe aren't that interesting. I think those unloved stocks, and Qantas they've recovered a bit from now, but something where the chance of the government saying that's going to fail, I'm looking for stocks like that have some dividend, but they're not driven by, their value isn't driven by dividends. To be honest, we're dealing with a current market, an economy that no one has ever dealt with before. It's unrivaled.
No, and it's not. It's not even been compared to anything else, and the closest comparisons that we have so many different factors that go into it. I know that when we think about sort of the Great Depression, which is where it's getting compared a lot to at the moment, that took really effectively until the 1950s to really cover. You could say 10 years being conservatively before it sort of started coming back up. But if we sort of look at the systems behind it, they had war. So right up during that stage, they had a lot of manufacturing happening. They then had the rest of that sort of stuff going along with it. So it doesn't leave us in the same scenario at all.
It was spot on. I think the globalization that we have now, for better or for worse, depending on what's going on, wouldn't want to be a barley farmer in Australia at the moment. But I think that globalization and the technology just means that the ability for economies and companies to recover is fairly strong. We've got billions of consumers. So I think for people who are investing now, if you're investing for the long term, and again, this comes back to, if you're investing $100,000 now, $10,000 or $1 million now, look at your profile. If you have to take that money out in 2 to 3 years, you're probably very worthwhile considering very conservative stocks or cash, because we just don't know, to your point, Alistair, we just don't know how long this recovery is going to take. And it certainly won't be even. I mean, there'll be companies in sectors that perform better. There'll be sectors in countries that perform better. And no one has a crystal ball. It's something that, again, resonates from my days in advisory broking, talking to clients, and they'll ring and say, "Oh, so what do you think of this stock?" And for people who are new to investing, I think it's really important to remember that there isn't a stockbroker, including Warren Buffett as an investor, an advisor alive who knows what's going to happen tomorrow, unless they're trading on inside information. And if they did, the chances of them working are pretty remote. So brokers are certainly better placed than the average investor to know what's going on with the company. They're talking to companies, they're talking to analysts, they're talking to clients. They do this 50, 60 hours a week, so they're in a better place than the average investor is. But they still don't know. And I think that's important. So people need to figure that out.
I mean, one of the paradigms that I always find is that whenever I do get asked, what do you think of that stock? And it's commonplace, especially when you're in the industry, amongst your friends to ask, or family members, and sometimes it's general public or someone new that you've met. I've always found that the hardest question to answer is kind of the when, because they always want to know when's it going to happen. And it's one of those answers that you just, no analyst on the planet can say when. They might have an inclination or a better idea of when something is going to happen, but they can't actually say the exact timeline. You can't guess. You can only say what might happen, not when it might happen. So, I mean, I can resonate with that very well. I always find the same sort of problem with it. If you again, the same sort of question, I mean, would your answer change from, say, the 10K to 100K to then going to $1 million? Would you end up doing something very different with the money compared to what you've said with the other two?
With $1 million, I think you have a better chance to diversify across more industries. Again, I'll ignore putting money into cash and being smart. So ignoring cash, ignoring property. That if you had $1 million to invest, you'd probably be thinking about how do you get exposure to, I guess, those core sectors. I think with $1 million, you start to be able to consider other strategies within a listed portfolio. So talking about listed shares, and so we're talking then about, do you get into exchange traded sort of products? Do you look at other more of the synthetic or hybrids that allow you both to get some upside that's different to a direct share investment, some diversification that's different. So I think the more you have at your disposal, the more a broker and advisor can help you figure out a longer term strategy that is more interesting and more diverse, that is probably a little bit more challenging to do with a smaller amount of money. So again, we talk to people about what is the actual overall cost of investing. So you need to think about the fees you pay, the tax you pay. The more money you have, the more you need to protect that money, but also the more opportunities you have. So at that level, I think you are dealing with a whole different ball game. I still believe in diversity, but I think you have a lot more tools at your disposal to help you protect your money and potentially find some upside as well.
It certainly opens the door a lot more than what you would do with these smaller amounts. I mean, in my mind, I'd be going with the sort of 10K side of things. I'd be going absolutely as high risk as possible to get a turnaround on it. But then slowly, the more I get to the bigger numbers, I'm a hell of a lot less risky on the assets.
Yes.
In terms of books, TV shows, anything like that, what do you think has been the most valuable towards your trading career? In terms of one that you may have read or watched, it could even be an interview.
Traditionally, I haven't read a lot of books about trading. I like the biographies about great investors and great business people. I find their mentality, their psychology to be fascinating. So from the very obvious ones like a Warren Buffett or a Richard Branson, I love understanding their how they work, how they think, and how they build businesses, and using that insight to try and find other opportunities from people who are the same. And again, every large company started with someone small having an idea and looking for something in an emerging opportunity. So I spend more time thinking about the people behind the companies. People like Ray Kroc, who really took McDonald's from a small business to a global franchise. they're the sorts of things I enjoy. I don't spend as much.
So looking into that sort of innovative mindset sort of thing about how people might go about doing things.
Absolutely. I think you can learn a lot from how successful people go about their job, their life, their relationships, whatever they may be. And I find that much more interesting. And probably for the same reason now, I spend more time now listening to podcasts. I don't have a lot of time to sit down and read. Most TV does bore me. I've got a fairly short attention span. But podcasts I find quite interesting. And again, like we were talking about before, the global nature of the world now, the ability through technology to hook into information that 5 or 10 years ago we just couldn't do. Podcasts and similar platforms didn't exist. There is some amazing information available, which just, for me, I tend to think more about the bigger picture strategy. I'm less a stock picker than in the industry, I guess. I love the podcasts that just allow you to learn from other people and discover things you didn't realise before, whether it's an investment opportunity, a sector, a piece of technology. I think it's a lot easier to learn from other people than necessarily try and discover it yourself.
Yeah, no, absolutely. I 100% agree with that. What do you think has been your best trade you've ever had?
Without a doubt, I was lucky. Quite a few years ago now, I bought CSL, the old Commonwealth Serum Laboratories, and that was my father, who was a doctor, looked at those, and he said, "I'll buy some of these," and I did, and I held. They're one of the few stocks that I've held for a long time. They are now quite overweight in our portfolio. It's a fantastic stock. I don't know what the top is. I thought would have been to the top a number of times, and it just seems to keep on going. So it's probably one of the few shares. We talk about psychology of trading and investing. One of the few shares where I try and ignore the intelligent decision, which would be to sell and take profit. But emotionally, I just think they're a fantastic company. And every time I think they've probably reached their ceiling, they seem to, for some reason, find some more love in the markets, and they go again. So that's one that I will, without any reason, I think I'll hang on to for a long, long time.
And what do you think is your worst one?
I wish there was only one. Again, you remember the wins, right? So I think the winners, CSL, I can talk about all day. I can talk for hours about CSL and the journey. I blank out the losses. But the reasons for the losses, I know the reasons for the losses that I've had, and I think I've come out ahead over the years. The reasons for the losses have been for one of two reasons: fear or greed. Again, it's that you take a position in a company. Potentially, you don't understand it. You haven't done your work on there. You think there's an opportunity because there's been a change, a short-term change. There's been some pressure on the markets, and you think, they've come down by 10%. It's a good company, there must be a good opportunity, I'll buy those. And often stocks move because there's been a fundamental shift in their business model. Institutions, large investors don't like it for some reason, and they're a lot closer to the stock than you. So making ill-informed decisions is a fantastic way to generate losses, and I've certainly done that. And I've certainly done the same, where you think you can outsmart the market and there's hidden value. And again, doing that without actually spending the time to understand what's going on. So fear and greed, I think, to me, is what drives markets, right? That's the fundamentals of markets, and it's just a matter of how informed you are. But I could name a lot, but luckily I think because again, fairly conservative, I have avoided the cardinal sin of throwing good money after bad on most occasions, and I think that's always the tough thing to do as well. Is if you have your own rules around trading, it's one of the very, very important ones to figure out. At what point do you exit? At what point do you admit you've got it wrong? And I think the earlier you can do that, the better. And again, we've just seen Warren Buffett and Charlie do the same thing here with airlines. They are out of the airline business, and they've said, well, we don't know what's going to be, but we're going to get out. And then they're not afraid to cut losses and go. And I think that's an important, a hard, emotionally hard decision to make, but a really important one.
Especially when you're first starting out trading. I mean, you tend to get married to your position almost. And so this idea of, no, I haven't gotten it wrong, and you sometimes get overly emotional, walk away from it, come back and go, why did I get into that in the first place?
Yes.
Have you ever found that from your trading experience, your best trade or maybe some of the losers that haven't gone favorably, have you found that it's actually changed the way that you think about your trading or how you invest, regardless of what the asset class may be?
Look, in the heat of the moment, yes. I think you look at a trade or a transaction and you think, wow, I should have been there. I should have seen that one. Hindsight is that beautiful beast, isn't it? Where right in the heat of the moment, I think you can be encouraged to change your game plan, and that can do you a lot of harm. So I do believe you need to understand your own personality, your own appetite, your own situation. And if you're working with a broker, they need to understand what you're about as well, and you don't deviate from that game plan. If your game plan is, say, a 10-year plan to generate a certain return over that time with minimal losses, opportunities present themselves every day. Every day there's a chance in the markets to make money and lose money. The opportunities are always there, but you have to be able to figure out, does that opportunity match up with what you're actually trying to achieve? And so for a long-term strategy, changing your game plan every day, week, month, whatever it might be, whilst tempting, really should be done with a lot of thought and shouldn't be done in a hurry.
Certainly. And do you apply that to every single sort of investment you might be partaking in, or would you just apply that generally to your entire portfolio range?
I'm a top-down kind of person, so I certainly apply it across the portfolio. Look, there are opportunities where we see something and think, gee, that looks like a really interesting story, but I can't see how their business model, and by that I mean how they're going to make money sustainably for the next 3, 4, 5 years, stacks up. And because of that, I miss opportunities. Absolutely. I look at something like Afterpay. I had no doubt at all that Afterpay wouldn't survive. I couldn't see how they're going to generate the sort of cash that was going to make them a successful business. I thought companies like Visa and MasterCard would move in more quickly. And to be honest, a few weeks ago when they were down to that $8, $9 level, I thought, oh, there's a pretty good chance this is it for Afterpay. And that's a real shame. It's a great Australian success story. So I'm glad to get something like that wrong.
I have to agree. Like, even myself, when I kind of went, I'm going to just put a couple of grand towards it and see what happens. If they went bust, I was like, oh well. It was really one of those moments where I sort of looked and went, I got a gut feeling. Let's just put some play dollars towards it, not real money, and see what happens. But luckily they have managed to pull themselves off, which has brought a lot of focus towards not just Afterpay, but also stuff like Zipco, where they both have that same sort of format. And really, how many others are sort of going in that sort of way? It could just be a generational sort of thing where we're seeing the pay now, buy it now and get delivered of the product, as opposed to a lay-by sort of a format, seems to be working quite well. But how is that going to affect, the difference between credit card sort of suppliers and the interest side of things, and where they're really going to go in the future?
Spot on.
Leaves a lot to be, up for question, really, doesn't it, at the end of the day?
Absolutely.
So now moving on to sort of some of the other questions that we've got sort of planned for you today. At Chatham Capital, you focus mostly on unlisted sort of markets and sort of this angel investing side of things for established sort of businesses that have already got a bit of a track record. Do you find that the transference of skills between what we talk about in investing circles for financial markets fits the bill for unlisted markets as well?
Absolutely. There's a lot of crossover, and fundamentally in whether you're in listed shares or some other public security, or in the private markets, unlisted companies, fundamentally what an investor is looking to do is understand the value of that business. And the difference between the listed and unlisted, fundamentally, with listed shares, it's a transparent market to a certain degree. You can see the buying and selling pressures on either side. The disclosure requirements on the company is quite strong. And so information flows more freely, but fundamentally it's a battle between buyers and sellers for different reasons, a battle of value determination. How do you value a share? And so whether it's a listed or unlisted company, it's quite similar. Now, the way that value exchanges is quite different. It's much easier, clearly, on listed shares to buy 10 shares, 100 shares, 1,000 shares, whatever it might be, and the process is quite straightforward. Unlisted companies, much more complex, it takes a lot more time, but fundamentally shares don't change hands unless there's an agreement of value between a buyer and the seller. So fundamentally, those skills are quite transferable.
Yeah, I mean, in one side, you're sort of looking at almost an auction process that's going on behind the scenes versus on the sort of private side of things, it's more of an agreement or a negotiation setup that really occurs. Yeah. Do you find that the information, because you do get more information on one side, that people get sort of paralysis by analysis in looking at listed products versus looking at the unlisted side where you kind of just got all the facts in front of you that you've got available to you at the time, and you probably don't have anywhere near as much competition? So does that mean that it gives you a little bit more time to really consider and evaluate how you might go about having an investment in a certain market?
I think the opportunity and the advantage of listed markets, whether you're an experienced, sophisticated investor, professional investor or not, the big advantage in listed shares is that you have a ready-made market, and that means you can buy a smaller amount or a larger amount, so that the risk, even if you're investing a larger amount of money, the risk is lower because of that ability to buy and sell in that ready-made market. Now, clearly, a property transaction is different. If you're buying an actual physical property, it's more like buying an unlisted company. The challenge in unlisted companies is if you buy or invest in, so let's say you're an angel investor and a company's raising $2 million and you're putting in $200,000, you have to be prepared to hold that investment for realistically probably closer to 10 years to try and get a decent return. And it's very, very hard in that 10-year time frame to get your money out again. And really you invest with a view that I'm not going to get that money out again unless this company goes to an IPO or there's a trade sale or something similar. And the risk along the...
So yeah, there's a lot more risk on that side that your money could be tied up, and it's certainly nowhere near as liquid as an investment as what most people in financial markets would be used to.
Absolutely, and that's one of the reasons why with Southern Angels that I'm involved with, we don't, as a member, we won't admit people as members unless they are experienced investors. So by that we mean they understand how the stock markets work, and the money they want to invest is money they can afford to lose. Nobody likes to lose money, that's pretty clear, but it has to be money they can afford to invest and lose, because the chances of losing money as an angel investor is far, far greater than losing money as an investor in the stock market. And part of the reason for that is your inability as an investor, as an angel investor, to get money out again. If the company's going backwards, if the cash flow is drying up, there isn't a market to sell shares to. So that's very, very tough. But also the requirements on listed shares, on listed companies for disclosure, the listing rules with the stock exchange, the requirements through ASIC, etc., are far greater. So you have a lot more protection from a regulatory point of view than in private companies. So there are very, very different risk profiles between what you'd have to take to a listed investment versus an unlisted investment.
When it comes to the unlisted or the angel side of investing, do the same sort of diversification principles apply? Like, I imagine it would be quite difficult to sort of put the same sort of dynamics into a portfolio as you would for unlisted compared to financial markets, where you can quite quickly and easily diversify as you see fit to try and ratio out those beta and alpha profiles. But when you get to it on the unlisted side, you really don't have that information at your disposal. So what do you do to try and diversify the unlisted sort of stuff?
Patience is a virtue for angel investors or venture capital, private equity, it's all very, very similar. Diversification is key. It really is key. And you'll find most professional investors will also have 4 or 5 industries that they have a focus on, because you have to be comfortable with the dynamics of those industries, and you have to really understand how those industries work and whether the company you're looking to invest in has a chance of success. So it's quite different. Diversification in listed shares, you can probably spread across a number of different industries, and it's easier to invest and transact. Privately, the private investors, diversification is key, But it might take you, let's say, go back to your question previously about if you had $1 million to invest. If you're an angel investor, that $1 million, let's say you'd spread it, most would look to spread probably at least $100,000 over 10 investments. So that might be quite similar to how you might invest in listed shares.
Yeah.
The difference would be if you were investing in listed shares, you might invest that money over maybe 2, 3, 4, 5 months. You probably drop in buckets of money as the markets move to try and get some sort of spread across the ups and downs of the markets. For unlisted companies, it might take you 1 to 2 years or more to deploy that $1 million. And the reason for that is it just takes longer to find the good companies. It takes longer to do the due diligence. It takes longer to invest. So it's just going to take you longer to invest that money. So diversification.
I mean, even when you do actually invest, into an unlisted sort of investment or an angel side of investing, then do you tend to find that even that with the deployment of the cash, like it's not always a direct thing. It might be milestones that they have to make before they get the next deposit of funding. Is that a way that sort of de-risks it for the clientele that go down that path?
Certainly is, and there's a lot of negotiation between angel investors, venture capital investors, and the founders of a company about what is their runway. So we talk a lot about runways for early stage investment. So at the moment we talk to companies about needing probably 2 years of runway, meaning 2 years of cash to be able to sustain the company, pay the employees and so forth. And rather than giving them, let's say, $1 million today and saying, well, that should get you through the next 2 years, you might say, I'll give you $300,000 today, that'll get you through the next 6 months. If you meet these milestones, exactly as you just said, Alistair, if you meet these milestones, which might be around product development, about customer acquisition, then we'll give you the next lot of money. And it's purely, as you said, purely a risk management strategy. It's giving the investor an option and saying, well, I don't want to keep on throwing good money after bad. And especially for early stage companies where you often have someone who is a very smart technical founder. They might have a great product. That doesn't necessarily mean they know how to run a company. It doesn't mean they know how to run a team, how to do marketing. And often these companies, early stage, they've got 1 or 2 or 3 or 4 people, whatever they're able to fund, and they have to wear many hats. If you go to a listed company, even the smallest listed companies, whether it's a bio stock or a resources company, they might have a small team, but they've got a team who probably have a bit of experience. There's often a governance board, and that governance board has certain obligations on them which private companies don't always have. So there certainly it's a riskier proposition, and milestone payments, things like convertible notes, are ways or tools that are often used in private investment, in angel investing, just to provide that de-risk strategy.
So when you're actually looking for investors, or you're finding sort of those angel guys to try and invest into a listed sort of thing, what would make you sort of let's say hypothetically they've passed really being a sophisticated investor, and it's been established via that know your client side of thing that's all cool. What would make you steer them towards back towards perhaps listed investments over unlisted, or to a completely different asset class that would make you go, well, we're not quite sure that this is going to be a good fit for you? What does that usually look like?
So the interesting thing for angel groups, and this is the same for angel groups across Australia, and there's a number of them in Australia. Angel groups tend to be more of a meeting place for sophisticated investors, a bit of safety in numbers, learn from each other. They're not advisory groups. So I think there's a difference there, that if you're an angel investor, you have to be willing to make your own decisions about what suits and what doesn't suit. But certainly when we talk to people about becoming an angel investor, whether that's themselves directly, and you can go and do this yourself, or joining a group, there's a few things which are important for someone to understand and go, is angel investing right for me, or am I better off being in a listed company? And they're things like, what's my investment time frame? Now, I think most advisors, whether it's a financial planner or a stockbroker, whatever it might be, would talk to an investor and say, you really should have a 3 to 5 year time frame for your investments, and ideally longer. Now, if you're looking to make money in the next 12 months, you'll probably find it pretty hard to find an advisor who would happily write a recommendation for you, because no one knows what's going to happen in the next 12 months. Angel investors need to be prepared, as we spoke about before, to lock their money away for up to 10 years. So if someone's looking for a short time frame, even 3 to 5 years, angel investing is not the right place to be. So there's a few key pieces like that. And so the reality is there is a very small number of people in Australia, you might measure them in thousands, maybe 10, 20, 30,000, who probably are suitable to consider angel investing, investing by themselves into unlisted companies. For the majority of people, a majority of investors, even sophisticated investors, that ASIC definition of a sophisticated investor, they are probably better off being an investor in listed shares or some other version of a listed entity, a managed fund or whatever it might be, than being in an unlisted. I think you invest in unlisted shares in private companies partly because you're passionate about a certain industry or you're passionate about technology. You've got a certain interest that's beyond just making money. I think you really have to have a passion, because a lot of angel investors get actively involved with the company they're involved with. They'll try and help them find customers. They'll help them with other strategic perspectives. You don't do that.
It's a very different role compared to the research that you might go into a financial markets investment versus the angel side of things. It really leaves the door open for you to be actively involved in helping grow that company. It gives you that reason to actually be doing it as well, because you've got a financial interest in it.
Absolutely. Even a small investor. Now, a lot of angel companies will say, we're not too fussed about who the smaller investors are going to be, because you tend to be a bit more passive if you're a smaller investor. But cornerstone investors, foundation investors who are putting in larger chunks of money, they really expect to roll up their sleeves, get involved. And the reason they're doing that is because they want that company to have a big exit in 10 years' time. And again, smaller companies, founders, are often very good at what they do. That doesn't mean they're necessarily great at running a business and navigating the long term. So it's a very different mindset. Angel investing certainly is for the minority of very experienced investors. It's not something that's that the majority of investors really probably should consider.
So, looking at your sort of time as a board member, what's it all been like? What have been some of the key challenges that you sort of see on a day-to-day basis? And how do you sort of feel about it now compared to when you first sort of started?
The fascinating thing about the role a board plays or a board member plays, and having seen that from being in operational businesses where information flows up to the board, to sitting around the board table reporting to the board as an executive, having been a board member, I think what's interesting about board members in Australia primarily, I won't comment about overseas markets, but in Australia primarily, is how hard it is for a board member to separate their role at a very strategic level around risk or governance or compliance. So how the company's travelling financially in the long term with what's happening on the day-to-day basis. Now, how deep do you have to dive as a board member into the day-to-day to make sure you know what is happening in that company that you're responsible for, versus not being involved in the day-to-day? And for anyone who's been a member of a company that's reported to the board, I'm sure they'll be aware of just how much information boards can request and how much time that takes up of people within the team. And a board report that might take 2 weeks, 3 weeks put together might be considered for 10, 15 minutes at a board meeting. So I think there's a really interesting dynamic and a very great skill for the chair of a board, especially a governance board, to be able to balance the board and the conversations at a board level between what's going to be effective and efficient to meet governance requirements and not going to distract from the day-to-day members of the team. Having said that, in the last 12 months, especially looking at these listed companies, go back to the Banking Royal Commission as a great example, and we're still seeing impacts. It was a Westpac only recently coming out with their Austrac issues. It would appear that a number of board members were not across what was happening within the business and weren't across the governance and the controls and the risks within the business, and clearly they were spending their time talking about either other issues, or they were taking information that was being presented at face value and not diving in earlier. So it's Boards in Australia are fascinating places, and I think the model we've got at the moment, the balance between legislation and responsibilities, practical responsibilities, hasn't, for many companies, I don't think, hasn't quite been balanced properly yet.
And what have you found to be more enjoyable? Have you preferred being the guy on the board, or have you preferred being sort of presenting to the board, which I imagine can be quite daunting to some?
I think if people are honest, very few would say they enjoy being a member of staff reporting to a board. It's this great unknown, and I think the challenge with the challenge of a very good board member is to know the right questions to ask, and be able to ask them in a way that encourages information to flow freely. And I think understand the business well enough that they can get information out quite clearly. There is the hours that get spent, especially by listed companies, regulated companies, APRA regulated companies, etc., in creating board reports that often don't add a tremendous amount of value, is significant. So I think that's always more interesting, and a lot in terms of time and effort. Clearly, it's a lot easier to be a board member. Having said that, the risk of being a board member, the regulatory risk, the risk from a corporations law perspective, is significant. So, to be honest, the place to be, if you want to be a board member, the boards you want to be on, and I think where you really get an ability to help build a company, isn't in a governance position. It may be in the executive position. It really is the advisory boards, where you get to help build out companies without that risk profile. But still the ability to add value from a governance perspective and a strategic perspective.
And so what tends to happen in the day-to-day when you're at a board meeting? Is there a lead up to what you have to be doing researching before, or looking at some of the stuff that might be presented on the given day before the meeting, or is it all done on the day? The
great frustration, and I'm sure those who've been board members and those who present to boards, the great frustration I think for at a board level is that the amount of work that's done by a board member before and after a board meeting should be quite significant. So if you spent 4 or 5 hours in a board meeting on once a month, you probably should be spending 4 or 5 hours before that meeting, considering the papers that should have been sent out to you beforehand, and you probably have a couple of hours afterwards to be checking back through minutes, notes and outcomes. So a half a day board meeting a month probably would require at least a day, if not more, of pre and post activity. And a lot of board papers should be taken as read. They are the factual documents. It might be a compliance report, a risk report. Those are things where no action should be needed by the board. It's simply presenting information to them. Good boards should have, from an efficiency point of view, a good process of saying this report is for action, this one is for your information, this one is just for knowledge, whatever it might be, that allow board members to focus on what's going on. And I think there's some parallels between what it's like to be a board member and what it's like to be an investor in listed shares. Board members, and I had a very good CEO at one stage, who used to say before each board meeting, make sure we go back and remind the board where we were a month ago or 3 months ago, whatever the particular situation was, because board members are busy, they're doing other things, they have other jobs, so they walk back into a room, they haven't thought much about it for the last few weeks, and we start talking about an operational issue and they've completely forgotten what was going on beforehand. So you need to remind people of what was going on. And I think there's a big parallel there for the average investor who might look at a share today and read about something and go, that looks interesting. I'll come back and look at that in a month. A lot can change in that month. And I think that's where, for directors, it's having a good executive team that can remind them of what's going on and make sure they call out that information quickly, and a good advisor who can say to a client, okay, you're asking about this stock, a month ago they were here, here's what's happened in the meantime, and this is what it might mean to that business.
So for both, a board member and an investor, it's really about making sure you've got that big picture in your mind as often as possible when comparing to what's going on each individual day within that month, or the changes that may occur.
Absolutely, and how the art of any good advisor, whether it's an executive to a board, whether it's an advisor to an investor, is the ability to distill a lot of information quickly to those key points. People don't have a lot of time for whatever reason, whether it's rightly or wrongly, they don't have a lot of time. And most people want, and we see this in our advisory business a lot, most people don't want to know all the information, they want to know what to do next. Right? And they want some basis for that decision. So I think the ability to be able to say, here are the 2 or 3 reasons why you should do something, here's what we've based that information on, here's our thinking. If someone can get their head around that in whether it's 5 minutes, half an hour, whatever the relevant time frame might be, it's much easier to get a decision from someone and for that decision to be fully informed than to say, well, here's 500 pages of information, or here's our opinion, but there's nothing backing it up. So I think there's an art to communication that good advisors, good consultants, good board members understand, and that's to me such a big key to success, is understanding that communication piece and what's important. And a lot of that comes just from time and experience. I think that's the advantage that spending time in an industry, and advisors that have been around for 20 years just have a lot more opportunity to go through good and bad markets and learn people and psychology. And I think there's you can't learn that at university. You don't learn that from doing your CPD points. It can help you, but I think the ability to say to someone, here's what I'm thinking, here's why, here's what I'm basing it on, and here's the logical conclusion, in any form of life, I think is a valuable skill to have.
Absolutely. A bit of grey hair goes a long way. I certainly know that if you had have asked me to advise people sort of 10 years ago, I would have been probably not giving the best advice. Mm-hmm. But that's all changes with the experience that comes with it. How did you end up becoming a board member?
I think like many people, I started, I played a lot of sports, been involved in different sports teams, and I think if you have an interest in helping organisations to grow, then often you get dragged into committees. So I think for me it started with committees, going back into sporting teams. It sort of then followed into getting involved at schools. And kids go through schools, and often parents get involved there, and I have, I guess, a fairly strong community participation sort of view. And so followed on from there. My first role in a board, after having reported to them and getting a feel for what boards did as a reporting employee, was with a not-for-profit. And there was a not-for-profit in a sector that I was quite passionate about. And I actually saw an advertisement, and it's just relatively rare. I think often board roles get filled with a tap on the shoulder from a network, which is something I'm not too fond of. I think that sort of inwards-looking networks don't often get the best outcomes. But I applied, rang the CEO, had a conversation. They were fairly keen for the skills that I had, so it was more coincidental. And that was my first board role in a not-for-profit in the sort of health industry a number of years ago. And from there, through work, I've now been on a number of advisory boards. And the nice thing about advisory boards, and I think for people who like to help companies grow, who've got a background in professional services of some sort, whether it's sales or marketing or whatever it might be, there's a number of companies that have advisory boards, and they're not about getting paid the sort of dollars that a governance board would get. And the governance boards take on significant risk, personal liability. Governance boards have a lot of obligations and requirements that advisory boards don't. Advisory boards are very much, or good ones anyway, are very much focused on how that company is going to grow. It's a sales and marketing, it's referrals, it's advice, it's helping that business move forward. So certainly I think in terms of where I enjoy spending my time, the advisory boards are often a lot more fun and enjoyable because you're helping build a company. That's fundamentally what they're about. Governance boards by default, a lot more time spent on risk, compliance, your obligations under corporations law, and because of that, often the conversations are focused around those areas. So they tend to be less focused on growing the business, which fundamentally is the reason why companies exist, is to grow and be better. Right? But unfortunately, with legislative requirements, a lot of the time at the board level, you're dealing with things that are more focused on keeping the company in out of problems with groups like ASIC, which is clearly important. But my preference is for advisory boards.
So do you tend to find that the governance and advisory board members will get together simultaneously, or are they separate meetings?
So you tend to have companies, who have a governance board don't tend to have advisory board. So you have one or the other. So larger
Right.
companies, whether it's a listed or unlisted company, will often have a governance board when they have the size of assets, the size of staff, or the risk profile. So you don't tend to have both running in parallel. Most governance boards are really listed in large private companies. Advisory boards tend to be, I guess you call your small to medium enterprises. I think as soon as you take money, we're talking about, say, an angel investment type of business, as soon as you've got other people's money invested, is kind of a trigger for when you tend to move into a governance board type of role. If it's one or two people running their own company, they're probably more suited it's more acceptable to have an advisory board, because the shareholders tend to be the people sitting around the table anyway. So they can have their own discussions.
Yep.
You don't need to have independent shareholders appointing their own board members, which is that mechanism that a governance board allows you to have.
Yeah. And I mean, when it comes to sort of being involved in the board, do you tend to find that certain topics take more priority than others?
Yeah.
If you've got a variety, if, let's say you had, one of each in the meeting to cover that day, which ones tend to take the more priority? Is it the more compliance governance side of stuff, or is it likely to be more the advisory and sort of business growth side of things?
So in a governance world, a good board, and a good board is managed by the chair. A good board with a good chair will work out over time how to get the information they need for the key areas around risk and compliance and so forth, how to get that information efficiently and effectively, both from the time it takes to produce the reports, but also the time it takes to discuss them at board level. So ideally you want to know that you've got confidence in your systems and processes to get that information through to the board quickly, and the board can then look, and whether it's a traffic light type of system or some other type of system that quickly says to the board, we have 10 areas we're looking at, these 8 are green, there's no issues there, 1 is orange, 1 is red. Then you can spend the time talking about what is red and make sure that there's some clarity around how to resolve that red issue. The quicker you can do that in confidence with the information you've got, then the more time you can spend talking about how to grow the business, the better. And I think that's what we've seen through the Royal Commission, is that the risks that were within the operational part of the business weren't being communicated through to the board, or they were being communicated in a way that was buried in reports and data that didn't call out those key areas, those key risks clearly enough. And I think that's where information overload becomes a problem. Now it might be that boards ignore information too, but more often than not, I think it's the process where a key risk, it's been like the Titanic pointing at the iceberg, that key risk that's going to sink the ship, there isn't a way to communicate that clearly. And so as a default, most board members now are very clear about what their own personal obligations are, spend more and more time trying to dig into what risks are, because they need to satisfy themselves, because that's their number one obligation, is to make sure that the company's complying with legislation. So the harder you make it for a board member to do that, the longer they're going to spend trying to figure it out for themselves.
And when you think of big boards for whatever it may be, it could be something like the RBA. Who are these sort of first boards that, if you were looking at investing in things or looking at economic sort of circumstances for an entire country or population, what are the sort of things that you look for in a board to sort of say that you think they've made a well-rounded decision?
Diversity is becoming more and more important, and we see a lot of discussion around diversity, and I can't recall the statistics, but there's a couple of issues we've got with diversity in Australia. One is that we have, in my opinion, too many of the same board members sitting on multiple boards. And that's an issue for a couple of reasons.
Yeah.
Right? One is that professional board members might be very experienced people, but they're going from one board to the next, and they're quite diversified. So whilst they've got experience, they're also not really getting the chance to get to know their business they're sitting on the board for very, very well. So it's that sort of board members club. And the other challenge, I think, in Australia, especially in the top listed shares, is that a lot of the board members, if they're not the same people on multiple boards, they are predominantly the same type of people. Right? So what we
So you don't get that sort of challenge of opposing views or different experiences occurring. They end up being almost homogenous.
Correct. We don't have enough young voices on boards. We don't have enough female voices on boards. We probably don't have enough boards from diverse backgrounds. And I think that's the opportunity. If you look at the companies that have grown remarkably well in the last 5 years, and a lot of these companies are tech companies, right? They are being influenced by founders and board members who are much younger, and they are looking at a new world, a new economy, and building products and building companies that are being valued in different ways. And it's very hard if you're raised in a market that has been, say, from the 60s or 70s or 80s, and your viewpoint is built by generations of time. It's very hard to look at a brand new technology and get your head around that if you're spending 90% of your time talking about companies that have been around for 10, 20, 30, 40, 50 years. And so having a voice on the board that is diverse, that is prepared to be heard, is critical. And I think at the moment in Australia, that next generation of board members that hopefully starts to come through will be a fresh of breath air for both for boards, but more importantly for the investors.
Okay, I think that's quite cool. The young blood side of things is certainly not something that, whilst I've considered, a lot of the time you do get that predisposition to be a board member, you need to have some level of grey hair. So it's an interesting take. I quite enjoy that breath of fresh air. The breath of fresh air. So, I mean, really, the last question I have for you today is, what are the most significant opportunities, some of the challenges, and maybe the changes that you think the industry is really going to be facing? I was initially going to ask you about sort of next 1 to 3 years, but it seems sort of in hindsight with the current state of global dynamics that looking perhaps 3 years ahead is maybe a little bit too long.
Next 6 months would be nice to know what's going on, wouldn't it? It's to have a crystal ball. I think that's the challenge. The fascinating thing about investing, and I think why people love it, and the opportunity that comes from being involved in the markets, whatever those investment markets are, I think the exciting thing is that no day is going to be the same. And if you look at the bigger, longer term picture, the companies that will probably influence our listed entities, the indices, in 5 years' time, many of those haven't been created yet. And I think that is a dramatic change, and a point that's been made time and time again. The top stocks now, in the US markets especially, were companies that 10, 15 years ago didn't exist. And I think the challenge for, say, someone like myself, who tends to be more of a buy and hold long-term player, is knowing when the companies you're invested in now no longer have a business model that meets the environment that those companies operate within. And I think that's going to be much, much harder for both for investors but also advisors to figure out, is when is a company that was once a great company no longer relevant, no longer valid. And I think that's going to be the challenge.
And that is something that you don't tend to sort of hear from most investors. They think about the now, not the when, which is always the case. But knowing when perhaps a company has expired its valuable use and something else has replaced it purely due to technology or something else is going to be interesting. I mean, the perfect example of this is probably car markets. With the push towards electronic vehicles now and away from gasoline-based engines, is when are we going to see that? Like right now, we have a big overlap, but when is it going to start pushing towards that EV side of things to be environmentally friendly, so to speak?
Spot on. Tough questions, right? And they need a lot of time to consider them. And I think that's the key. Again, I come back to looking at understanding your own psychology, your own appetite. And then finding advisors, it's assumed that people work with advisors. I think it's a smart thing to do. Find an advisor that understands your psychology but also is thinking in some diverse ways, because that's what you're paying them for. That's the value they should bring, because they should be spending their 10, 20, 30, 40 hours a week thinking about those issues so that you don't have to. I think that's the key. Investing should be a partnership. And when we think about what will change in the next 5 to 10 years, it's much easier to minimise the risks if you work with someone who spends more time thinking about it than you just. A bit of that, again, the adage, surround yourself with people smarter than you are. I think it's a way to minimise your risk.
Well, I thank you very much for attending with us today in the podcast for ACY Securities. And I'm hoping that we can get you back perhaps in maybe 6 months' time to have a look and see where things have progressed from today and really go over what you see is facing the new challenges again and probably go back to that last question that I had before. Hopefully that'll be the case. But in any way, thank you very much for attending. It's been a pleasure talking with you today, James, and we look forward to seeing you next time.
Alistair, I've loved the chat. I'd love to catch up again, maybe when we can do this face-to-face when COVID is no longer such an issue. So thanks for your time.